Story this week. The US Federal Reserve begins a two-day meeting today where it will decide whether to raise the benchmark interest rates or not. That rate has been held near zero since the global financial crisis in 2008. Investors and analysts expect a moderate increase of 0.25 percentage points, and Fed Chief Janet Yellen has clearly said that any increase would be very gradual. Unusually low interest rates have helped lift stock prices over the years since the Federal Reserve has been careful about not upsetting a fragile economic recovery. And the market, of course, braces up for the first Fed rate hike in nearly a decade. So here are some top market watchers with their expectations from Janet Yellen.
I think we do see the Fed is getting off zero. It has been, as you say, last rate hike cycle began in 2004. So I think the Fed wants to get off zero. They're going to go out of their way to say it's going to be very gradual. I think the interesting story is for 2016, how they communicate that liftoff.
It basically speaks to raising interest rates very, very gradually. And so that should comfort the market in terms of liquidity, but there's no doubt going forward that, it's a changed world in terms of liquidity.
Well, look at Federal Reserve. They must be prepared to tighten and ease at the same time. They must be prepared to tighten and then within 6 months go to negative interest rates. They must prepare to stimulate and they must prepare to withdraw liquidity.
I'm almost certain it's going to be a rate hike, but I think it's going to be a rate hike that's going to be wrapped in a very dovish Christmas package, if you will. That I think could encourage the market. Everyone is worried with the nervousness in the high yield. Well, my goodness, the Fed is bumping up. What's going to happen? And I think once they turn around and see that the Fed, I'm not saying it's going to be one and done. People are talking that might be it, but I think it's going to be one and wait a long.
Normally, when the Fed gets ready to tighten, it's because the economy's picking up speed and accelerating, and top-line revenues and corporates are accelerating. This time, we're 2 or 3 years past that moment in the recovery. So we're not going to see that expansion of corporate revenues here that would help buoy asset prices while the Fed starts to tighten.
I think it's definitely priced in terms of the first move. 25 bips, Fed fund target between 25 and 50 bips will be most likely the announcement.
Well, the Fed's doing this because they see the economy strengthening, right? We're getting good labor market prints and inflation looks like it's picking up. So we're not going to neutral. We're taking the foot off of the accelerator a little bit, going from 0 to 25 basis points.
And on the back of that, let's take